Hello and welcome to LCG's preview for the week ahead. I'm going to discuss a possible October stock market crash, the EU Brexit Summit, China third quarter GDP and Q3 earnings from Netflix. But before that, I'll run down the biggest events in the economic calendar. On Monday there is US retail sales. On Tuesday, there is Reserve Bank of Australia meeting minutes, UK unemployment and wages for the 3 months through August, and Eurozone trade balance. On Wednesday, it's the EU Brexit Summit, UK CPI and FOMC minutes. On Thursday, it's Australian unemployment and UK retail sales. And on Friday, it's China GDP, retail sales and industrial production, and Canada CPI. Now moving on to the top corporate results to watch this week, where US earnings season enters its first full week of results. Bailey Gifford and Bank of America will report earnings on Monday. Bellway, Johnson & Johnson, Morgan Stanley, Goldman Sachs, IBM, Domino's Pizza and Netflix will report on Tuesday. ASOS and Kinder Morgan report on Wednesday. Novartis, eBay and PayPal announce numbers on Thursday. And finally on Friday, Volvo comes in with an earnings update. So turning to this topic of an October stock market crash, obviously sounds quite alarmist, but there's some justification for talking about it. We did have the third biggest daily decline on the Dow Jones ever. That was points decline rather than percentage. Obviously those declines in number of points goes up as the value of the index goes up. But nonetheless, it seems like a repeat of what we saw in February, at least the beginnings of it, rising bond yields, accompanying obviously falling bond prices and stock prices rolling over with those bond prices. So this is always a concern for money managers because the whole basis for investing is that you hold a diversified portfolio of stocks and bonds. Obviously, if those two asset classes are falling together, it makes having this diversified portfolio quite difficult. So that potentially what we're looking at here, a kind of universal fall in those main asset classes. There has been some doubt about the equity rally since those lows in February. Certain aspects of the market not necessarily showing strength. For example, volume has been weaker on rising prices. Some of the best performing shares have been the most heavily shorted during the correction in February. Fund flows from retail investors have dried up. So a number of technical factors which would suggest not so much confidence in this recent price move. So technically we hit a new high in the Dow Jones. We weren't able to sustain it and the markets rolled over quite dramatically. It looks like a potential double top here if you're talking about technical analysis. Obviously, we all know the justifications, probably the biggest factor out there being the trade war. Trade war thought to be inflationary for the US, driving up prices. Obviously, it's hurt emerging markets so far, but then the question is, will it start to hurt the US so much that the Fed has to really heavily raise rates? And historically, you get a higher cost of money. At some point, you're going to start seeing some kind of issues in the market. And so remains to be seen what that will be, but we have started to see growth in China slow, things like that, which could get exacerbated when their dollar-denominated debt goes up. All right, moving on from that correction talk, we do have the EU Brexit Summit. I'm not going to drag on about this because we have so many of these summits, but potentially an important one. It's an extra meeting of the 27 nations on October 17th. The idea is they can agree a final withdrawal treaty offer. So that will be something that will basically set them up for another special summit on November 17th to 18th to complete the terms for a political declaration for a future trade agreement between the EU and the UK. So in the home stretch, hopefully here for Brexit, and we're certainly seeing the British pound do pretty well under these conditions. So we'll have to see what comes of this summit. It obviously all could fall apart. That's actually what happened at the last summit. Switching gears to China GDP, so we're expecting 6.6% year over year, down from 6.7% in a quarterly basis, looking at 1.6% quarter over quarter instead of 1.8%. So narrow declines, but does kind of feed into that general idea that China's economy is slowing. So ideally they would want to stimulate the economy to still meet their growth targets, but obviously if they do cut interest rates and do things like that, then actually they risk the yuan weakening even more. So we talked before, I think it was last week, about the yuan hitting, getting close to that 7 level against the US dollar. They want to stem capital outflows as well. So a bit of a tricky tightrope for China to be walking right now. So this will be a little clue for the market as to how difficult it is when those figures hit next week. We've also got retail and industrial production numbers, as we mentioned. Last but not least, Netflix earnings. So this is just, it's always a good one to watch. Obviously tech stocks quite volatile. They're all priced to perfection. You obviously get big moves to the up and downside if they meet or miss expectations. Tech has been out of favor, as I mentioned before, for the last month or so. Seen healthcare, energy, other sectors outperform. They obviously have led this market higher over the last 10 years. Netflix has been right at the top of that. Before this correction, Netflix shares were up around 80% year to date, so still doing very well. They're down about 20% from the highs, so kind of dip buying territory potentially. The numbers last time around wasn't a massive miss. They missed on subscriber growth. This is in Q2 by 1 million. This is just basically in a context of the last few quarters where they've been exceeding expectations by around 1 million. So a bit of a disappointment there, and the shares have been dropping since. And again, this background of tech. So I think if they can exceed expectations again on subscriber growth, don't put out too many worries about future numbers. When you look at the earnings growing 135% year over year, you've got the fundamental backdrop for this. It might be a reason for investors to jump back in if they can beat those expectations. But the stocks, the shares looking a little bit soft at the moment. Right, thank you very much for watching and good luck for trading this week. And if you want to see these videos as soon as they're released, please follow LCG on YouTube and social media.